Imagine it's 26th February 1979. You are a 34-year-old cloth merchant living in Deira, Dubai, United Arab Emirates. Your apartment sits above your shop, close enough to the creek that the smell of salt and diesel reaches your window before sunrise. You keep your savings in a metal box, count every dirham by hand, and know the sound of Dow engines better than the sound of birds. Most days are simple: tea at dawn, invoices by noon, bargaining until evening, then a slow walk past the souk lights before bed. The city still feels small enough that news travels faster than the traffic. But this morning people are talking about something far from your shop, out in the desert by the sea, where a port so large it seems almost absurd is about to open. If you have ever wondered how a city with limited oil turned itself into one of the richest places on earth, stay with me. What you are about to hear is not a theory. It is a pattern hidden inside roads, ports, airports, and laws. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never stop to notice. By noon, word spreads that Queen Elizabeth II has opened Jebel Ali Port. Some call it vision. Others call it madness. Why build a giant harbor in the sand when the city is still small, the population is tiny, and the future is uncertain? That question takes us to the center of this story. Because Dubai did not become wealthy by simply pumping oil and waiting for luck to do the rest. It became wealthy by using a short burst of oil money to build a machine that could earn from movement itself. Ships moving cargo, planes moving people, laws moving capital, and ambition moving talent. In other words, Dubai stopped thinking like a place that sells what is buried underground. It started thinking like a place that sells access, speed, and trust. And once you see that, the skyline makes more sense. The airport makes more sense. Even the desert makes more sense. Before we go further, there is something important to understand. Most people think wealth comes from owning a thing, a gold mine, a fertile field, an oil well. But there is another way to get rich. You can own the bridge instead of the cargo. You can own the station instead of the train. You can own the marketplace instead of the goods. That is the secret key to Dubai. The city did not need endless natural resources if it could become the place where everyone else's resources, goods, money, and travelers had to pass through. A hub economy sounds technical, but the idea is simple. Imagine a giant roundabout at the center of a busy town. Every truck, every visitor, every package, and every meeting passes through that roundabout. Now imagine that the town keeps widening the roads, making the rules simple, building warehouses on the edges, and making sure the lights almost never fail. Over time, the roundabout becomes the town. That is what Dubai built. Oil mattered. It absolutely mattered, but oil was the match, not the firewood. The real engine was infrastructure, which means the big physical systems that make trade possible, and institutions, which means the rules and legal protections that make strangers willing to risk money in your city. Dubai used limited extractive wealth to create repeat business. Not one sale from one barrel, but thousands of small cuts from thousands of transactions. A container unloaded at a port, a passenger changing planes, a company renting office space in a free zone, a hotel booking, a financial firm paying fees, a property transfer. This is why Dubai's story is so misunderstood. It is not the story of a desert that got lucky. It is the story of a leadership class that treated geography like raw material and time like capital. They built early, sometimes too early, and then invited the world to fill the empty space. The city was not mining wealth, it was building a toll bridge across globalization. To understand how unusual that was, go back to the late 1960s. In 1968, Dubai's population was just 59,000. That is smaller than many towns most people have never heard of. The city had traders, pearling history, and a useful creek, but it did not have the overwhelming oil wealth of Abu Dhabi next door. Then came the discovery that changed the scale of what was possible. On 3rd August 1966, Conoco's Fateh 1 well struck oil offshore. Dubai began exporting oil in 1969. For many places, that would have been the end of the story. Oil arrives, government spending explodes, consumption rises, imports flood in, the country becomes rich on paper and lazy in structure. But Sheikh Rashid bin Saeed Al Maktoum made a different wager. He treated oil revenue less like a permanent salary and more like temporary seed money. Seed money is startup money, the first money that lets a bigger plan begin. He had already pushed to dredge Dubai Creek earlier because the creek was the old artery of trade. But oil gave him the chance to think much bigger. Port Rashid opened in 1972, Dubai Dry Docks followed in 1983, and in between came the most audacious move of all, Jebel Ali Port, opened on 26 February 1979. Huge, expensive, and to many observers wildly oversized. At the time, it looked like someone had built a cathedral for a congregation that did not yet exist. But that was the point. A port is not just a dock. It is a magnet made of concrete. Ships go where unloading is fast. Factories go where shipping is easy. Traders go where paperwork is simple. Banks go where traders gather. Workers go where jobs multiply. Families follow workers. Schools, hospitals, warehouses, hotels, and highways follow families. Wealth then looks sudden, but the real trick happened years earlier, when the first slab of concrete was poured. Jebel Ali did not merely serve demand, it created demand. And this brings us directly to one of the most important case studies in modern economic history, the launch of the Jebel Ali Free Zone, or JAFZA, in 1985. It began with just 19 companies. Today it hosts more than 11,000 businesses from around the world. In the past 20 years alone, it has attracted more than $30 billion in foreign direct investment to Dubai, and together with Jebel Ali Port, it has helped create over 1 million direct and indirect jobs. In 2024 alone, JAFZA marked $190 billion in trade over the previous 12 months, while Jebel Ali Port handled 15.5 million containers, measured in TEUs, the standard box unit used in global shipping. That is not decoration. That is an economic engine. Now slow the story down and look at what ordinary people experienced. A dock worker unloading steel coils did not need to understand macroeconomics, which means the big forces shaping an economy, to feel the difference. He saw more ships, longer shifts, more warehouses, more trucks. A small trader in electronics could stock faster. A customs broker could build an entire middle-class career just moving paperwork between firms. Indian, Pakistani, Iranian, Arab, and later European and East Asian business communities found a place where goods could arrive, clear, store, re-export, and finance with unusual speed. Dubai was becoming less like a traditional city and more like an enormous switchboard, connecting one market to another with a fee at every touch point. The surprising part is that this model did not require Dubai to own everything passing through. It only had to make passage more attractive than the alternatives. That is a much lighter way to build wealth. You do not need to grow the wheat if you own the mill, the warehouse, and the shipping lane that moves the flour. And this is where many people miss the deeper mechanism. Dubai was not diversifying away from oil by accident. It was diversifying by design. Oil money built the runway for a non-oil future. It financed the conditions that allowed foreign companies to do business faster, more cheaply, and with more flexibility. By 2025, DP World itself could say openly that less than 1% of Dubai's GDP came from oil. Think about how radical that is. A city long associated in the public mind with petroleum built its modern wealth mostly by making other people's commerce more efficient. The oil well lit the first lamp. The port built the power grid. Here is something I want you to think about before we go further. If you had been standing in Dubai in 1985 with a modest shop, a growing family, and no crystal ball, would you have bet on a giant port in the desert or called it a costly fantasy? Drop your answer in the comments, seriously. Because what I'm about to show you next is the part of this story that most people never hear. And it changes everything. A port can pull in cargo, but an airport can pull in an entire world. In March 1985, Maurice Flanagan was tasked with launching a new airline for Dubai in just 5 months. The seed funding was only $10 million. That is a large sum for most people, but tiny compared with the scale of what followed. On 25 October 1985, Emirates flew its first routes from Dubai to Karachi and Mumbai, using 2 aircraft wet-leased from Pakistan International Airlines, a Boeing 737 and an Airbus A300B4. It sounds almost modest now. 2 planes, 2 routes, 1 ambition. But the mechanism was enormous. Aviation compresses geography. That means it makes far places feel closer in time. And in a global economy, time is not just comfort, it is money. If a city can connect Asia, Europe, and Africa with fewer hours, fewer visa headaches, better service, and tighter schedules, it becomes more than a destination. It becomes a habit. Dubai understood this earlier than most. The city was not trying only to attract tourists who would stay a week at a beach hotel. It was trying to become the default place where routes crossed, deals happened, cargo moved, conventions met, and travelers paused between continents. If Jebel Ali was a concrete magnet for goods, Emirates and Dubai International Airport became a jet-powered magnet for people. There is a reason this mattered so much. Travelers do not arrive alone. They drag entire supply chains behind them. A passenger arriving on an aircraft supports baggage systems, caterers, mechanics, cabin crew, taxis, hotels, software, security, retail shops, restaurants, cleaners, fuel suppliers, cargo handlers, travel agencies, and eventually real estate. 1 seat sold on 1 flight may look small. Scale it across decades, and it becomes an economy. Dubai International Airport opened back in 1960 with a sand-compacted runway and a small terminal building. By 2014, it had become the world's busiest airport for international passengers. By 2024, it welcomed 92.3 million guests, a new record, connecting 272 destinations across 107 countries, while Dubai airports reported that over the previous decade, DXB had handled more than 700 million passengers on over 3.3 million flights. An Oxford economics-backed report released through Dubai Airports said aviation supported 27% of Dubai's GDP in 2023, equal to 137 billion dirhams, or about $37.3 billion, and supported over 630,000 jobs. Those numbers are impressive, but the lived experience is where the city changed shape. A young Keralite baggage handler could arrive on a work contract and send money home for siblings' schooling. A Filipino hotel receptionist could build a career in hospitality because passenger volume never stopped feeding the hotels. A Lebanese restaurateur could open a branch because international foot traffic made high-end dining possible. A British executive could base regional operations in Dubai because clients could fly in and out with ease. A Sudanese trader could use Dubai as a midpoint between suppliers in Asia and buyers in Africa. Emirates was not only an airline, it was a flying conveyor belt feeding every other sector. The airport became a river in the sky, and every hotel, shop, office tower, and mall along its banks learned how to drink from it. Now here is where it gets interesting. Most governments say they want tourism, business travel, cargo growth, and global relevance. Very few are willing to build the full chain that makes those things reinforce one another. Dubai did. It built the airline, expanded the airport, marketed the city, grew hospitality, synchronized customs, improved roads, and kept linking air travel to real estate, retail, trade, and finance. That is why the success of Emirates cannot be understood as a lucky business story. It was part of a system. The city was building a flywheel, which is a heavy wheel that gets easier to spin once it gathers momentum. More flights brought more visitors justified more hotels and attractions, more business visitors attracted more regional headquarters. More headquarters meant more premium traffic, cargo, events, and financial services. The wheel spun faster, and yet even this was not enough. Ports and planes can move goods and people, but capital, which is money seeking a safe and profitable home, is more nervous. It does not only ask whether a city is connected, it asks whether the rules are clear, it asks what happens if a contract fails, it asks whether foreign owners have rights it can understand. This leads to the third part of the story. In 2002, Dubai made a decision that changed its property market forever, allowing foreigners to buy freehold property in designated areas. That turned parts of the skyline into a globally tradable asset. Then, in 2004, Dubai launched the Dubai International Financial Center, or DIFC, under the vision of Sheikh Mohammed bin Rashid Al Maktoum. This was not just another office district, it was a legal and financial island built to run under an independent regulator and an English common law framework. That matters because many global firms already knew how those rules worked. In plain English, Dubai did something very clever. It did not ask international capital to think like Dubai. It built a place inside Dubai where international capital could behave in familiar ways. That move was more revolutionary than most skyscrapers. A tower is visible. A legal system is not. But invisible plumbing is often what makes the whole house livable. DIFC gave banks, insurers, asset managers, law firms, and private wealth offices something they value almost as much as profit: predictability. By the end of 2024, DIFC housed 6,920 active companies, up 25% from the year before, and added 1,823 new registrations, the highest annual number in its history. Its workforce grew to 46,078. It included more than 260 banking and capital markets companies, 410 wealth and asset management firms, including 75 hedge funds and 125 insurance and reinsurance firms. Its clients included 27 of the world's 29 globally systemic banks, which means the very largest banks whose failure could shake the international system. Dubai was no longer only a place where goods passed through. It was becoming a place where contracts, investments, disputes, and balance sheets could pass through too. Think about the ordinary experience behind that shift. A Jordanian lawyer finds regional clients because arbitration cases are handled in a familiar legal environment. A young Emirati finance graduate does not need to leave for London to work on cross-border deals. An Indian wealth manager can serve families with assets spread across several countries. A family office from Europe can base regional operations in a jurisdiction designed to feel legible rather than mysterious. Even construction workers, receptionists, taxi drivers, data analysts, and coffee shop owners benefit when financial density grows. Money does not walk into a city alone. It rents apartments, it eats lunch, it hires people, It fills schools. It buys compliance software. It pays for fit-outs, cleaners, drivers, and conference halls. Capital is shy at first, then strangely social once it trusts the room. At this point, the pattern becomes impossible to ignore. Most people will never know what you now know. Most people will keep trusting simple stories because simple stories are easier to repeat. Oil made Dubai rich. End of story. But if you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for. The part they never put in textbooks. Now observe what all of these cases have in common. The same mechanism, different sectors, different decades, same result. First, limited oil revenue created a pool of capital. Second, that capital was used to build oversized infrastructure and unusually flexible business zones before demand fully arrived. Third, each piece of infrastructure was designed to feed the others. The port fed trade, trade fed finance, finance fed real estate fed tourism and services, the airport fed all of them, the law zones reduced fear, the free zones reduced friction, the brand of the city amplified the entire machine. This is why Dubai's rise often feels unnatural to outside observers. They are looking for a single treasure chest. There isn't one. Dubai's wealth is closer to a web than a mine. Pull one strand and several others tighten. A cargo shipment at Jebel Ali may lead to warehouse leasing, trucking contracts, insurance policies, legal work, hotel stays, bank fees, and future flights. A financial firm opening in DIFC may create demand for office towers, restaurants, schooling, luxury retail, and premium air travel. A tourist arriving for a long weekend may later buy a second home, open a company, or move wealth into the city. None of these flows look as dramatic as crude oil gushing from the ground, but together they form a much more durable pattern because they are diversified. If one stream slows, another can keep moving. There is also a deeper economic lesson here. Natural resources are stocks. A stock is a pile of something sitting in one place. Once you sell it, it is gone. Connectivity is a flow. A flow can renew itself every day if people keep choosing your city. Dubai moved from extracting a stock to organizing flows. That is an entirely different type of wealth. It depends less on what you have and more on how useful you are. In that sense, Dubai turned itself into a service platform for 3 continents. It monetized location, logistics, convenience, reputation, and legal familiarity. Geography did matter, of course, but geography by itself is not destiny. Plenty of places sit at crossroads and stay poor because the roads are bad, the rules are confusing, or the politics scare everyone away. Dubai's leadership kept trying to remove the frictions that made business slow. In economic history, removing friction is often more valuable than discovering treasure. And yet, history also shows something uncomfortable. Machines built around global flows can spin forward very fast. They can also shudder when those flows freeze. Look at what happened next. In the 2000s, Dubai's growth story began to lean too heavily on real estate, leverage, and ever-rising optimism. Leverage means borrowing a lot to amplify gains, like trying to lift a heavy stone with a long metal bar. It works brilliantly until the bar snaps. Foreign ownership rules, giant master developments, cheap credit, and a hot global money environment helped fuel a property boom so intense that many people started to believe the city had escaped old economic laws. Towers rose faster than neighborhoods matured. Sales offices sold dreams in glossy brochures. Taxi drivers swapped property tips. Mid-level managers bought off-plan apartments, which means properties purchased before they were even finished, hoping to flip them for quick profits. The skyline became a scoreboard, and everyone wanted points. Then the global financial crisis arrived, credit dried up, confidence cracked. On 25th of November 2009, Dubai World asked creditors for a standstill while restructuring part of its debt. IMF reporting tied the immediate restructuring issue to about $26 billion, while wider estimates of Dubai-related obligations ran much higher, in some discussions toward $80 billion. Markets panicked because nobody was fully sure who backed what, who owed what, and how deep the liabilities went. Abu Dhabi stepped in with $10 billion in support in December 2009, helping Dubai avoid a more chaotic unraveling. But the pain was already real. Property values fell sharply. Some analyses suggested residential prices in parts of the market dropped by more than 50% between late 2008 and late 2009. Projects stalled. Cranes froze. The city that had looked like a perpetual motion machine suddenly felt like a theater after the electricity cuts out. And this is where history gets uncomfortable. The people who suffered first were often the people with the least cushion. Construction workers lost jobs as sites went silent. White-collar expatriates lost positions, and because residency was tied to employment, many had to leave quickly. Families packed apartments in days, not months. Newspapers carried stories of abandoned cars at the airport, a detail repeated so often it became almost a symbol, whether every version was true or not. Behind the symbol was a real fact. In Dubai, losing income could also mean losing your right to stay. That makes a downturn feel less like a recession and more like a trap door. Small business owners saw customers disappear. Commission-based salespeople watched deals evaporate. Middle-class households with too much debt discovered that a glamorous boom can turn cold faster than concrete sets in the desert night. But notice something else. The city did not disappear, the port did not vanish, the airport did not vanish, the legal zones did not vanish. The core machine bent, but it did not break. That matters. Because there is a difference between an economy built on pure extraction and one built on infrastructure plus networks. When oil prices fall in a one-dimensional resource state, the pain can be total. In Dubai, the 2009 crisis exposed excess, opacity, and dangerous borrowing. Yet it also proved that the deeper architecture still had value. Trade kept moving. Geography did not move. Firms still needed a regional base. Flights returned. Tourists returned. Capital returned, though more carefully. The city had built more than a bubble. It had built a platform, and platforms can recover if the wiring underneath is strong enough. The question is not whether this pattern will repeat. History has already answered that large boom cities always face moments when speed outruns judgment. The only question is whether you will see the structure beneath the story before the next headline tries to simplify it for you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. The historical record shows that those who came through Dubai's hardest periods with the least damage largely shared a few characteristics. First, they understood what kind of city Dubai really was. They did not confuse a flow economy with a guarantee of permanent asset inflation, which means prices rising forever. They knew the city's strength came from trade, aviation, legal flexibility, and connectivity, not from the magical belief that every apartment would always sell for more next year. People closest to productive systems, port operators, logistics firms, high-skill service workers, strong exporters, well-capitalized hospitality groups, and firms embedded in regional trade often had sturdier ground beneath their feet than pure speculators. Second, survivors tended to keep optionality. Optionality is a simple idea. It means keeping room to move when conditions change. In practice, that often meant lower debt, more cash, broader networks, transferable skills, and business models tied to real demand instead of only rising prices. The boring merchant with cash reserves sometimes survived better than the flashy broker with 5 properties bought on leverage. The family firm with diversified clients across Africa, South Asia, and the Gulf often held up better than the single project developer living on borrowed time. People who treated Dubai as a platform rather than a casino tended to make clearer decisions when the music slowed. There was another shared trait, and it matters because it is easy to miss. Many of the people who weathered Dubai's sharp turns had portable human capital, which means skills they could use in more than one sector or more than one country. A logistics manager who understood customs, shipping schedules, and procurement could move from port work to aviation cargo. A bilingual accountant could serve traders 1 year and hospitality firms the next. An entrepreneur with suppliers in India, customers in East Africa, and financing in the Gulf was not trapped inside one local cycle. In boom years, portability looks boring. In hard years, it acts like a spare engine. Dubai rewarded people who could plug into networks rather than cling to one narrow lane. The city rose by connecting worlds, and the people best able to survive inside it were often the ones who knew how to connect themselves. Third, the people and firms that endured were usually those that respected rules, paperwork, and institutional detail. That sounds dull. It is not dull when market sees. During easy years, everyone looks smart. During hard years, legal structure becomes oxygen. Clear contracts, clean balance sheets, strong counterparties, recognized jurisdictions, and conservative funding turn from boring background matters into the line between survival and panic. This is one reason DIFC and similar institutional moves mattered so much. They were not just about prestige, they were about giving serious long-term actors reasons to stay when the mood darkened. There is a broader lesson here too, and it reaches beyond Dubai. Many governments talk about diversification as if it were a slogan. History suggests it is a sequence. First, you need enough capital to build. Second, you need the discipline to spend that capital on systems, not only status. Third, you need rules that make strangers feel safe. Fourth, you need patience because empty ports and half-booked flights can look foolish before they look visionary. And fifth, you need to survive your own success because once money starts arriving, speculation always tries to ride on the back of real growth. Dubai managed the first four brilliantly. The fifth has been harder, and that is exactly why its story is worth studying. It is not a fairy tale. It is a case study in ambition, design, overreach, correction, and reinvention. Now return to that cloth merchant in Deira in 1979. He could not have known the full shape of what was beginning when Jebel Ali opened. He only knew that the city felt restless, as if it had stopped fitting inside its old skin. Over the years, he would watch more ships arrive than he ever imagined. He would see traders multiply, roads widen, neighborhoods stretch, and languages mix in ways that made the old town feel like the center of a much larger map. His children might not stay in cloth at all. One might work in cargo near the port. Another might join an airline office. A niece might study finance and work in DIFC. A cousin might sell hotel supplies to visitors who arrived on flights that did not even exist when he was young. That is how structural change really feels in ordinary life. Not like one explosion, more like the tide quietly reaching streets it never touched before. So how did Dubai build wealth without depending on natural resources, by refusing to depend on them for long? It used limited oil revenue as launch fuel, then built a city designed to earn from circulation rather than extraction. It sold convenience, legal clarity, storage, routes, safety, scale, and speed. It turned a modest trading settlement into a platform where the world could meet itself. That does not mean the model is risk-free. No such model exists. But it does mean the usual story is wrong. Dubai did not become rich because oil was endless. Dubai became rich because its leaders acted as if oil was temporary. That is a very different mindset. One extracts and spends. The other builds and compounds. One digs a hole, the other builds a crossroads. And that is the part worth remembering. In economic history, the winners are not always the places with the deepest wells. Often they are the places that use a short window of advantage to build systems other people keep paying to use. The well eventually slows. The systems, if they are good enough, can outlive the well. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.